Welcome to Talk Tickers.
Glad to be here.
This is the show where we strip away the noise, we bypass those mainstream headlines, and we get straight to the mechanics of wealth.
Right. The liquidity and the actual legislative shifts that move the needle for your portfolio.
Exactly. We aren't here to sell you a mutual fund.
No, definitely not.
We are here to analyze the machinery of the market. And on this deep dive, we are covering what I am calling a massive silent liquidity event.
It really is silent.
It's just hit the accounts of millions of Americans, yet the financial media is treating it like, I don't know, a simple policy update.
Yeah, they're completely focusing on the politics of it. You know, the
a heining ceremony in the Rose Garden.
Exactly. But we are looking at the bank accounts.
We are talking about the Social Security Fairness Act of 2023, which finally crossed the finish line. President Biden signed it into law on January 5, 2025.
That's right. And while the headlines are all cheering about fairness and repeal and, justice, the professional investor needs to look at this through a totally different lens.
A structural lens.
Precisely. This isn't just a feel-good story for retired teachers and firefighters. This is a structural change to the income floor of a massive demographic.
It represents the reversal of over 40 years of established benefit calculations.
It's a capital event.
It is. And whenever you reverse a 40-year-old financial structure, you create shockwaves.
Massive shockwaves.
We are witnessing an immediate income surge for affected demographics. We're talking civil service retirement system folks.
The CSRS group.
Right. Police, fire, teachers. But it triggers a secondary mechanism that we call the tax trap.
The tax trap is the silent killer of returns here.
Yeah.
Because this law didn't just flip a switch for future payments.
It came with a retroactive component.
Yes. That means unsophisticated investors, or honestly even sophisticated ones, who just aren't paying attention to their adjusted gross income.
Their AGI.
Right, their AGI.
Yeah.
They are about to walk blindly into a buzzsaw of tax liabilities and Medicare surcharges.
So here is the agenda for this deep dive. We are going to break down the mechanics of the now defunct Windfall Elimination Provision,
The WEP.
and the government pension offset.
The GPO.
We need to understand exactly how the math worked before so we can fully grasp the magnitude of this change.
You have to know the history to understand the present.
Exactly. Then we're going to run the numbers on the restoration of benefits. And finally, we will dissect the tax and Medicare implications of these retroactive lump sums that are hitting bank accounts throughout 2025.
It's a classic case of good news, bad news.
How so?
Well, good news is obviously the money. The bad news is the IRS is watching that money very closely.
Always. Let's start with the headlines. The core event. President Biden signs a repeal on January 5, 2025. But the effective date is the critical detail here, isn't it?
It is. In the world of legislation, the signing date is often completely different from the effective date.
Right.
In this case, the law is retroactive to benefits payable after December 2023.
After December 2023.
That is the key phrase. Benefits payable after December 2023.
Let's unpack that for everyone. That effectively covers all of 2024.
Correct. It means every single month of 2024, plus the early months of 2025 leading up to the actual implementation, are subject to this repeal.
So it covers the entire calendar year of 2024.
Every day of it. This isn't just a going forward raise. This is a looking back windfall.
And who is the impact population here? We casually mentioned teachers and police earlier, but let's get specific. Who is actually getting squeezed by these rules?
The technical term the government uses is non-covered entities.
Non-covered, meaning they didn't pay into the system.
Right. These are employees who did not pay Social Security taxes or FICA on their earnings. The biggest block here is the old federal workforce.
The civil service retirement system?
The CSRS. If you were hired by the federal government before 1984, you are very likely in this bucket.
But it's not just federal workers.
No, not at all. It includes a massive number of state and local municipal employees in states like Texas, California, Massachusetts, Ohio.
A lot of public school teachers in those states.
Exactly. Teachers, police officers, firefighters who do not pay into Social Security. They pay into their own state pension funds instead.
So the mission of this law, effectively, was to stop penalizing these people for having those separate pensions.
Precisely. The stated mission was the full restoration of Social Security benefits. The goal was to eliminate the penalty factors that previously reduced their payouts just because they had a government pension.
And the immediate implication is cash flow.
Pure cash flow. We are seeing monthly income increases that are permanent, stacked directly on top of one-time retroactive lump sum payments.
It's a massive liquidity injection for this demographic.
Huge.
But to understand why this is such a big deal, we really have to understand why the restriction existed in the first place.
Right, it didn't just come out of nowhere.
I think a lot of people assumed the government was just being punitive, but there was a real mathematical logic to it back in 1983, wasn't there?
There was. We have to transport ourselves back to 1983.
Ronald Reagan is president.
Tip O'Neill is Speaker of the House. And Social Security is facing a massive solvency crisis.
The system was bleeding money.
Bleeding money. They needed to tighten the belt across the board. The Social Security amendments of 1983 were born out of absolute necessity.
And during that review, Congress looked closely at the benefit formula itself.
They did. Now, Social Security is designed to be progressive. It's weighted heavily to help low-income workers.
Explain how that progressive weighting works.
Well, if you make minimum wage your whole life, Social Security replaces a very high percentage of your pre-retirement income.
Right.
But if you are a high earner, it replaces a much lower percentage of your working income.
Because it's a safety net, not just a straight savings account.
Exactly. It's social insurance. But here was the problem they found, the double dipping logic.
The double dip.
Congress looked at these government workers, let's say a career federal executive making a great salary.
Living comfortably.
Very comfortably. They have a fat government pension. But because they didn't pay FICA taxes, their Social Security earnings record showed zeros for all those years.
So to the Social Security computer system.
To the computer, that high-paid federal executive looked exactly like a destitute, low-wage worker.
Because they only saw the few years they maybe worked a summer job or a side hustle.
Right. They had very few covered years, so their average lifetime earnings looked tiny. Consequently, the progressive formula kicked in.
And gave them the high replacement rate intended for the working poor.
Exactly. That is the optical illusion of poverty.
The optical illusion of poverty. That is the perfect way to describe it.
They looked poor on paper to the Social Security Administration, but they were actually quite wealthy with their government pensions.
So Congress decided that was an unintended windfall.
Yes. They saw these folks getting a subsidized Social Security check on top of a robust government pension.
And so they created the WEP, the Windfall Elimination Provision.
To remove that exact advantage, to strip away that unintended subsidy.
But they didn't stop there. They also introduced the GPO, the government pension offset.
Right. WEP affects your own work record. GPO affects spousal and survivor benefits.
The logic there was similar, wasn't it?
It was. Spousal benefits were originally designed for dependent spouses. Historically, the stay-at-home wife who relied entirely on the husband's income.
Right.
Congress argued, wait a minute, this woman was a career government employee with her own substantial pension.
She wasn't financially dependent in the way the original 1930s law intended.
Exactly. So they created the GPO to offset that spousal benefit against her government pension.
It was an attempt at fairness in 1983.
Based on the data they had, yes.
But over the decades, it became viewed as a brutal penalty, especially for lower-income public servants.
It really did. It might have made sense for the wealthy executive, but it absolutely crushed the widow of a firefighter.
Someone with a modest pension.
Right. She had a modest pension and suddenly found her survivor benefits from her husband wiped out entirely.
And that resentment built for 40 years.
40 years of lobbying, protesting, and introducing bills that went nowhere. Until we finally hit the legislative momentum of 2024.
It really accelerated at the end of the year.
It did. The House passed it 327 to 75 in November.
That's massive.
And the Senate passed it 76 to 20 in December. That is overwhelming bipartisan support.
Rare these days.
Very rare. It essentially marked the end of the substantial earnings tests and all those complicated exemption loopholes.
It wasn't just a tweak to the formula.
No, it was a complete deletion of the restrictions.
Okay, so let's get into the engine room. I want to deconstruct the formula for you.
Let's do the math.
We need to understand the old way versus the new way to see exactly where this money is coming from.
To understand the money, you have to understand A.
Average indexed monthly earnings.
Yes. Average index monthly earnings. Social Security takes your 35 highest earning years.
Only the years you paid into the system.
Correct. They take those 95 years, they index them for inflation to bring them up to today's dollars, and they come up with an average monthly number.
And then they run that monthly number through the bend points.
The bend points. The formula splits your money into 3 buckets, or brackets.
Walk us through those brackets.
The first bracket is the most generous. Social Security replaces 90% of the earnings in this first bucket.
90%.
For 2024, that was the first $11,174 of your average monthly earnings.
So for every dollar you earned up to $1,174, the government essentially gave you 90 cents back in benefit.
Exactly. Highly subsidized. Then you hit the second bracket.
Which is less generous.
Much less. That second bracket replaces 32%, and the third bracket replaces only 15%.
So that is the progressive structure we talked about earlier in action.
Yes, the higher your earnings go, the less they replace on the margin.
Okay, so that is the standard way. How did the WEP kill this for our teachers and firefighters?
The WEP attacked that first bucket directly. It was a precision strike on that 90% factor.
The most valuable bracket.
Right. Under WEP, if you had that non-covered pension, the formula slashed that 90% factor down to as low as 40%.
That is a massive haircut. You go from getting 90 cents on the dollar to 40 cents on the dollar.
It is brutal. Quantitatively, for a worker with 20 or fewer years of covered earnings, this reduced that first $11,074 significantly.
Let's run those numbers.
If you do the math, 90% of $1,174 is about $1,056.
Okay.
40% of $1,174 is about $470.
Wow.
That is a difference of roughly $586 a month.
That is nearly $600 a month just vanishing from a retiree's check.
Every single month for life. Now, there were guardrails.
Right, the cap.
The reduction could never exceed 50% of your non-covered pension amount.
Yeah.
And there's a phase-out system.
How did the phase-out work?
If you had between 21 and 30 years of substantial earnings in the private sector.
Meaning you paid plenty of FICA taxes.
Right. If you had those years, that 40% factor slowly climbed back up to 90%.
But for a career civil servant who never worked a second job?
They took the full hit, the maximum penalty.
That explains the WEP. What about the GPO, the government pension offset?
The GPO was arguably even more brutal. It used the two-thirds rule.
The two-thirds rule.
It reduced your Social Security spousal or survivor benefits by 2/3 of your government pension amount.
Walk us through a practical example of that.
Sure. Let's say you have a retired teacher. Let's call her Sarah. She has a CSRS pension of $55,000 a year.
A modest pension for a career of teaching.
Right. Now, 2/3 of that $55,000 is approximately $36,850.
Okay, so $36,850 is the offset amount.
That is her offset. Now, imagine her husband, who was a private sector worker his whole life, passes away.
Okay.
His Social Security record would normally entitle her to a survivor benefit of, let's say, $36,000 a year.
So under normal rules, she should get that $36,000. But the offset we just calculated is $36,850.
Exactly. Since the offset is higher than the benefit, her survivor benefit is wiped out completely.
Reduced to zero.
Zero. She gets absolutely nothing from her husband's Social Security record, even though he paid into it his entire life.
That is effectively a 100% tax on her survivor benefit.
It is. And that was the GPO penalty in action.
Yeah.
It devastated widows and widowers.
But now we are in the new way, the 2025 reality. The WEP is gone. The GPO is gone.
Gone, wiped off the books. The mechanics of the repeal are straightforward, but incredibly powerful.
Let's start with the WEP elimination.
For WEP, the formula reverts to the standard 90-32-15 split for everyone.
Across the board.
Across the board. It doesn't matter if you have a government pension. It doesn't matter how many years of substantial earnings you have. You get the 90% on that first bracket.
And is this fix automatic? Do people need to call the government?
For WEP, largely, yes, it is automatic. The Social Security Administration has the records. They know exactly who is getting hit by the WEP.
So they just rerun the math.
Right. They're automatically recalculating for existing retirees. You generally do not need to file an application for a WEP correction. You'll just see your check go up.
What about the GPO?
No, that is trickier. GPO elimination means full spousal and survivor benefits are now stackable on top of the government pension.
So Sarah, our retired teacher in the example.
Sarah keeps her $55,000 teacher pension, and she now gets the full $36,000 survivor benefit.
That is a massive income jump, almost doubling her income.
It changes her entire retirement picture. But here is the catch.
Is it automatic?
Not always.
Yeah.
This is a critical point for you to understand if you are advising family members or clients.
Okay.
Unlike WEP, GPO corrections are not always automatic.
Why not? If the government has the records.
Because many people never applied for the spousal benefit in the first place.
Because they knew the math.
Exactly. They knew they would get zero because of the offset, so they never filled out the paperwork. The SSA doesn't know you want the benefit if you never applied for it.
That makes sense.
Retirees must file applications for spousal or survivor benefits if they were previously denied or if they just never applied due to the offset.
Don't wait for the government to find you.
Do not wait. Go file. There is also a nuance here called deemed filing.
Deemed filing. Unpack that for us.
Deemed filing means if you apply for your own retirement benefit, you are deemed to have automatically applied for spousal benefits if you are eligible for them.
Okay.
For those who are receiving WEP reduced benefits on their own record, they might now be switched to a higher spousal benefit under the new rules.
Which could trigger substantial retroactive pay.
Substantial. And let's talk about that retroactive pay because this is the core of the liquidity event.
We mentioned earlier that the law applies to benefits payable after December 2023.
Right. So practically speaking, the SSA systems took a few months to update. The actual monthly checks started increasing in early to mid 2025.
But because the law backdates to January 2024,
retirees are receiving a lump sum catch-up check.
And this check covers all 12 months of 2024.
Plus any elapsed months of 2025 before the system finally updated their direct deposit.
So let's quantify this. If you are losing $500 a month to WEP and you get 18 months of back pay,
that is a $9,000 check hitting your account.
Just out of the blue.
Out of the blue. And for GPO, it's even more dramatic.
Because the GPO offsets were larger.
Much larger. Where the offset could be $1,500 or $2,000 a month, that lump sum could be $20,000 or $30,000.
Eating checking accounts all over the country.
Exactly. And this brings us to the investor context. This is where the rubber meets the road for financial planning.
This is what we call the tax trap.
It is an absolute trap because people see the cash and they think, windfall?
Time to buy a boat.
Right. But the IRS sees an income event. This combination of a permanent monthly increase plus a massive retroactive lump sum creates a severe distortion in your 2025 adjusted gross income.
Your AGI spikes artificially.
Off the charts for 1 year.
Let's break down the consequences of that spike. The first one is the IRMAA cliff.
IRMAA, the income-related monthly adjustment amount.
It's a mouthful.
It is. Most people just know it as the letter they get asking why their Medicare premium is suddenly so high.
Right. Medicare Part B and Part D premiums are means tested.
Exactly. If you make more money, you pay more for Medicare. It's that simple.
But there is a lag in how they calculate it.
A 2-year look back. And this is the trap. Your 2025 income dictates your 2027 premiums.
2025 income for 2027 premiums.
Yes. You get this lump sum in 2025, you spend it, maybe fix the roof, go on a cruise, help a grandchild with college.
The money is gone.
The money is gone. Then, in the fall of 2026, looking ahead to 2027, you get a letter from Social Security
saying your Medicare premiums have doubled or tripled
because your income in 2025 spiked.
Yet IRMAA is a cliff, not a ramp.
That is the most dangerous part. If you go $1 single over the threshold, your premiums jump for the entire year.
It's not a marginal tax, it's a cliff.
A hard cliff. The lump sum could easily push a retiree into a higher IRMAA bracket. We are talking potentially thousands of dollars in excess premiums in 2027.
Erasing a good chunk of the benefit they just got.
Exactly.
So can you appeal it? Can you go to the government and say, hey, this was a one-time legislative payment. It's not my normal income?
You can certainly try. You can file Form SSA 44.
Form SSA 44.
It's the standard appeal form for life-changing events. But here is the kicker. Currently, there is no specific checkbox on that form for legislative change of benefit payout.
They didn't build a box for their own law change.
No. You have options for marriage, divorce, work stoppage, loss of pension.
But Congress changed the law and gave me back pay isn't a standard appeal reason.
It is not. This is going to be a massive battleground for appeals in 2027. We're advising people to prepare for the fight, document everything, but do not bank on winning it.
That is a crucial insight. Do not assume the government will be reasonable about its own retroactive payouts.
Never assume that when it comes to the IRS or the SSA.
What about regular tax brackets? How does this AGI spike affect your 1040?
The AGI spike affects everything downstream. It can disqualify retirees from certain tax credits.
Like what?
Well, medical expense deductions, for example. You can only deduct medical expenses that exceed a certain percentage of your AGI.
So if your AGI goes up, your threshold goes up, and you lose the deduction.
Exactly. It also affects the efficiency of charitable deductions. And most importantly, it can impact the taxability of the Social Security benefit itself.
Explain that, because a lot of people don't realize Social Security is even taxable.
It depends on your provisional income.
Provisional income.
It's a specific formula the IRS uses. Essentially, your AGI plus half your Social Security benefit plus any tax-exempt interest.
Okay.
If your provisional income is low, you might pay 0 federal tax on your Social Security.
Which is how it used to be for everyone.
Right. If it's medium, you pay tax on 50% of it. If it's high, you pay tax on up to 85% of your benefit.
And this lump sum creates high provisional income.
Yes. So a retiree might go from having completely tax-free Social Security in 2023 to having 85% of their much larger benefit taxed in 2025.
So you have a bigger benefit, but a larger percentage of it is being thrown into your taxable income, plus you're sitting in a higher marginal tax bracket.
It's a triple whammy. And if you aren't careful, you might face an underpayment penalty from the IRS on top of it.
Because you didn't withhold enough tax during the calendar year.
Right. We call it the estimated tax pitfall.
How does that happen?
Well, retirees often rely on quarterly estimated tax payments. If you just pay what you paid last year and you completely miss the magnitude of this lump sum hitting your account,
you'll be severely underwithheld by December.
And the IRS will hit you with a penalty for not paying enough tax throughout the year.
Is there a hack for this? A way to fix it late in the year?
There is a withholding hack, specifically for those CSRS folks with federal pensions.
Okay, let's hear the hack.
Pension withholding is treated by the IRS as having been paid evenly throughout the year.
Even if you do it all in December?
Even if you do it on December 31st.
Wait, explain that. That sounds like a loophole.
It's just a feature of the tax code. If you write a check for an estimated tax payment in December, the IRS looks at the date and knows it was late for the first 3 quarters of the year.
And they penalize you.
Right. But if you log into your pension portal and increase the withholding for your monthly pension check in December to cover the entire year's tax shortfall.
The IRS treats that withheld money as if it came out in January, February, March evenly.
Exactly. They just see the total W-2 withholding at the end of the year and assume it was ratable.
So increasing withholding from the pension, not the Social Security check, but the pension.
Yes, the pension.
That is a safer way to cover the tax liability of the lump sum late in the year.
Precisely. It avoids the underpayment penalties entirely. You can essentially backload your tax payments via withholding without getting penalized.
That is a fantastic pro tip. What about state taxes? Does this AGI spike hit you on the state level too?
You really have to check your specific state laws. The federal government taxes Social Security. Most states do not.
But some do.
Some absolutely do. If you live in a state that taxes Social Security benefits, this retroactive lump sum is state taxable income too.
More taxes.
More taxes. You need to model it out.
Let's pivot slightly to portfolio construction.
Okay.
Because this isn't just a tax story. How does this permanent income shift change the way an investor looks at their asset allocation?
It fundamentally changes the definition of safe money in a retiree's portfolio.
Safe money, meaning bonds, cash, treasuries.
Right. For a CSRS retiree, they already had a government-backed bond, essentially, their pension.
A guaranteed monthly check.
Now they have a second fully restored government-backed bond, their full Social Security benefits.
So their guaranteed income floor just rose significantly.
Significantly. And in financial planning, if your basic living expenses are fully covered by guaranteed income streams.
You don't need to take risk to pay the light bill.
Exactly. You technically have a much higher risk capacity in your liquid investment portfolio.
Meaning your IRA or your brokerage account.
Right. You don't necessarily need to hold 40% of your portfolio in cash or low-yielding treasuries for safety because your monthly checks provide the safety.
You already have the fixed income built into your life.
Right. You might be able to afford a higher equity allocation to your portfolio to fight inflation over the long term.
That is a really interesting way to frame it. The bond allocation is effectively living in Washington, D.C.
Exactly. It frees up your capital to be more aggressive if that aligns with your goals.
What about Roth conversions? A lot of people use the early years of retirement to move money from traditional IRAs to Roth IRAs.
2025 is likely a terrible year for Roth conversions for this specific group.
Because your tax bracket is artificially inflated by the lump sum?
Exactly. The whole point of a Roth conversion is to pay the tax now while your rate is low, so the money grows tax-free later.
Buy low, essentially.
Right. In 2025, your marginal tax rate is temporarily high due to the retroactive lump sum.
So you're buying high.
You're paying a premium to convert. You should probably pause any planned conversions and wait for 2026.
When your income normalizes to the new permanent baseline without the lump sum noise.
That makes perfect sense. Don't pay a premium just because you happen to have the cash on hand from the back pay.
Right. Cash flow is not the same as tax efficiency.
People confuse those two all the time. Just because you have the cash to pay the tax doesn't mean it's smart to volunteer to pay it at a higher rate.
We have covered a lot of ground here today. History, math, tax mechanics, portfolio theory. It is time for the one question.
Yes.
This is the part of the show where we distill everything down to a single critical inquiry that you, the listener, need to make.
The one question for this deep dive is this. Have you run a pro forma tax projection for 2025 that isolates your retroactive lump sum to determine if you are crossing an IRMAA threshold?
Have you run the pro forma?
Yes.
And why does that specific question matter above all else?
Because a one-time cash windfall in 2025 can silently trigger thousands of dollars in excess Medicare premiums in 2027. It effectively erases a significant portion of the benefit you just fought 40 years to gain.
It's a stealth clawback.
It is. You need to know if you are $100 over the limit so you can take action before December 31st.
Like maybe donating to charity?
Donating from your IRA, using a qualified charitable distribution, or deferring other income just to stay under that cliff.
That is actionable, highly specific advice. Don't fly blind into 2027.
Do the math now.
Let's wrap this up with the key takeaways from all our sources and analysis today.
Number 1, WEP and GPO are dead. Full Social Security benefits are restored for public sector retirees, retroactive to January 2024.
The 40-year battle is over.
Number 2, spousal and survivor benefits are now fully in play. If you never applied because of the offset, you must apply now. Do not wait for the government to find you.
They won't look for you.
They absolutely will not. And number 3, the retroactive lump sum is a taxable event. Prepare for the inflated tax bill in April 2026 and the corresponding Medicare premium increase in 2027.
This is a massive win for the sector, there is no doubt about it. But the complexity has entirely shifted.
It has.
It used to be about calculating the penalty of the WEP. Now it is purely about managing the tax consequences of the windfall.
The game has changed, but the need for strategy haven't.
It really leaves you with a final provocative thought regarding the broader market when you suddenly inject billions of dollars of permanent guaranteed liquidity into the checking accounts of retired municipal workers.
The macro effects.
Right. It fundamentally alters the local economies. But more than that, how will this change future state and local pension negotiations? If the federal government is now fully subsidizing the retirement floor, municipal bond issuers might find themselves dealing with unions who have a very different baseline of wealth.
That is a completely different risk profile for municipal debt going forward.
Exactly. Thank you for joining us on this deep dive. Stay liquidity focused, stay informed, and watch those tax brackets. This is Talk Tickers.
See you on the next one.